Tomorrow, new European regulations restricting the short sale of equities and government bonds will come into effect. Initially envisaged to ease fears of a settlement failures when the short sale is naked, the regulations have morphed into something far more comprehensive and potentially problematic. The main problem relates to credit default swaps. These insurance-like products allow investors to hedge an underlying position or to speculate on a borrower's financial health. But European politicians and Eurocrats hate speculation and blame CDS trading by hedge funds for worsening the Eurozone crisis. With the new regulations, the EU has effectively outlawed any investor buying CDS on the government debt of a member state when they don't have an underlying position to hedge. With me to discuss the possible ramifications of this on Europe's bond market is Tim Gately, Head of European Credit Trading at Citigroup. Tim, thanks so much for being here today.
Thank you for having me.
I'll bring up a chart here showing the net notional volumes of CDS referencing Western European nations. As you can see, it's a huge ramp up starting here in 2010 when the Eurozone crisis started to rumble, but a fantastic dip here towards after the summer. Why is that?
Well, the chart itself actually coincides very well with activities in the market. So as you pointed out, beginning in 2010, the impact of the sovereign crisis really taking off in Europe, to the sharp downward moves in ECB and other regulatory and central bank action. And then if you look towards the end of the chart, going back in basically June through August in 2012, the impact has been directly correlated, from our opinion, on the sovereign ban. As investors were looking at the data and the information coming out on how the ban is going to impact them, and decided to exit positions before they became subject to it.
But why this delayed reaction? I mean, this ban came in, or was warned at least initially, passed in March, and it's coming now into effect tomorrow. But why is this sudden sort of unwinding of these shorts now? Is this just delayed, so realizing this is actually happening now?
Well, it's really happened over 3 months. First and foremost is because while the ban came out in the Parliament and it was under a lot of headlines and discussion in various papers, the information and the rules of the ban were slow to come out from the regulators. ESMA was writing the original set of rules, followed on by the local regulators, FSA. For us here in the UK, it's setting out the rules to the banks and how the exemptions were going to work, how reporting was going to work, what the thresholds were for the ban. And the information flow was very slow and confusing. So investors, right, understandably so, had difficulty determining what actually was going to happen.
Well, we can see some of the effect maybe in the chart we have on German bond yields over German CDS. We can see there's generally been fairly decent correlation up until 2012, a bit of divergence, but especially since September or so, we've seen the CDS price plummet, whilst the bond yields have actually been edging up slightly. I mean, is this showing, is this a kind of effect we can see? I mean, that the unwinding of CDS shorts has caused the price to collapse that dramatically?
Well, the impact of the basis across all sovereigns in Western Europe has been pretty dramatic. If you look at the peripherals, the basis went from very positive to very negative, implying that the amount of buyers in the CDS portion have pulled out of the market. If you look at the core countries, the basis is still positive, but went from being positive around 100, 110 basis points roughly to around 20 or 30 basis points today. The basis is a good indicator and sentiment of investor appetite. And as the chart shows, it coincides very well with the ban and the information flow that was coming out.
So when are we going to finally see the effect of this? I mean, what these new restrictions are going to have on the marketplace?
Well, it's very difficult to determine that. I think it's going to rely. We're going to have to rely on a kind of data that we look at over the course of the next kind of 12 to 18 months. Coinciding with the ban was the ECB action in September, and that certainly led to a risk-on rally in credit markets. So you saw it's hard to determine what percentage of the rally was driven by the ban itself versus what was accounts looking to add risk into the sovereign space.
Tim, thank you so much for being here today.
Thank you for having me.
Well, uncertainty is nothing new in the Eurozone. It will be interesting to see the final effect of these incoming regulations on the European bond market the next time the crisis rears its head.